Today, my guest is Ismael Reyes, the founder and president of MI Real Estate LLC and co founder of Stressless Capital Fund. Ismael has an incredible background, starting as a lieutenant colonel in the U.S. Army before transitioning to real estate investing. He's built a portfolio over 1,200 multifamily properties across the 5 states, and he's a best-selling author and an expert at passive multifamily investing, helping investors, especially those from Latin America, access high-quality U.S.-based real estate opportunities. Before we dive deeper, Ismael, can you give us a quick overview of what MI Real Estate and Stressless Capital Fund do?
Sure. And you covered it pretty well. But essentially, we acquire multifamily properties and other real estate, but it's usually multifamily properties. And we invest both passively and in some cases actively as well. And we asset manage some of the deals that we do. Initially, when I first started in my real estate, some of the investment was primarily passive, but we've transitioned into a much more active role. And now with Justice Capital, really focusing on providing valuable products that other operators are actually managing, and we essentially are using our expertise to really just understand what they're doing, keep track of what they're doing, but letting them do that and letting us focus on the actual raising of capital and bringing investors together for these acquisitions.
Awesome, yeah. And can you give a brief explanation of what the difference between passive investing and active is?
Sure. There's an actual legal reason, a tax reason for active versus passive. An active investor has to work a certain amount of hours, and it has to be the thing that they do primarily for work, right? You can't have a full-time job and then say I'm an active investor. It's just, from a tax purposes, it looks like you're evading paying some taxes, right? So
Yeah,
a
yeah.
passive investor can write off, and I'm not an accountant, but just haven't done this enough and over the years. Passive investor can write off $25,000 a year in passive losses.
Got it.
An active investor can write off all of their losses on any particular year against their active gains. A passive investor can only write off passive losses against passive gains. If you
Got it.
don't write them off, you can roll it up to the next year. But essentially, those are the big differences. So as an active investor, there are some additional write-offs that you can do, but that's because it's your livelihood. You don't have another job per se that's paying the bills.
Definitely. Got it. Makes a lot of sense. All right, we're going to go into a little bit of your background and your transition to real estate. So, can you share a bit about how that transition came about and what your experience was like in the military and then switching to real estate?
Yeah, I think just as a life choice, I've always Monopoly was always my favorite game, and I've said this before, but it's true. I mean, there's something about taking a piece of property and either improving it or just being part of the ownership of it. It's something that you can control. Now, yes, you don't pay your taxes, it stops being yours real fast, but for the most part, you own it, right? It's something that has value that you can see. Yeah, getting some other things like crypto where you don't really own it, or stocks where you don't really own it or know what's going on. That's a lot less tangible. It's not that it's wrong. I'm not saying people can do that, but I've been attracted to that. So even as a kid, I remember when we moved into our first house that we actually owned, the amount of work that went into improving that property, making it nicer, and just the feeling that you get from owning a property versus renting. I know that a lot of people nowadays say, well, I don't really want to own. That's not important to me. A lot of people that say that, they say it because they've never owned. They don't understand that tangible thing that you say, hey, nobody can take this from me, right? So it was just something that I grew up with. Life hits you and you got to do something, right? I didn't come from money. It's just a fact of life. I mean, it was a working family, did the best we could, but in order to pay for college and to figure out what I was going to do with the rest of my life, I joined the Army. That was the main reason I joined the Army. You get to have some experience, but also you get out of that is some educational benefits, and that was my main reason to join. And it just ended up being that once I joined into the National Guard while I was going through college, but I realized that I really enjoyed the military life too, right? So when it came to a point in my life where I had to decide whether I was going to stay out on the civilian sector, my degree was in psychology. Or do I pursue a master's in psychology? Do I work in psychology? or do I take the experience that I have and join ROTC and be an officer in the Army? That's what really I wanted to do at the end of the day. So that was my decision, right? So it was a matter of I really enjoyed it, the camaraderie of it, and I really enjoyed serving. I mean, there's something to be said about serving and doing something that goes beyond what's important to you, and you're actually protecting others, and that was something that was always critical to me. Now, jump 20 plus years, I still had that itch to do real estate, and along my military career, I would buy properties as we would move. I would buy a property, we would live there, and then I had a choice. Do I sell that property when we move to our next position, our next post, or do I keep it and I rent it? And most of the time I kept them. And so I had, I was kind of jumping across, in different places whenever it was stateside, and I would invest in a property to live in, and then I would move and then I would rent that.
Yeah.
But that strategy is good, but it's not the kind of strategy that helps you scale, because essentially you have, we had one or two properties in San Antonio, we had some properties in Florida, we had some properties in sprinkle here and a sprinkle there, and it's hard to manage that, and there's no
Definitely.
scale.
Yeah.
So when I retired, my goal was, okay, how do I love real estate? How can I do this in a way that really makes sense, that can help me scale and build generational wealth for my family? And so that's when we transitioned to multifamily.
Yeah, for sure. That's pretty cool. So you were getting these properties at every station that you were at in the military. That's very cool. Yeah.
When it worked, there were times where it's like, okay, do I really? There were some places where I knew I was only going to be there for a year, and it didn't make sense to buy, or we didn't like it, right? So it's like, do I really want to, because let's face it, not, the Air Force, they get all the nice places, but Army, you get put in some places where they're not so nice, right? And so,
Yeah.
but when it made sense, San Antonio, for example, had some, I was at Fort Sam Houston at the time. I know they've changed the name a little bit, but Fort Sam Houston has some very nice areas there. So we definitely bought in San Antonio a couple times, and we were there for 5 years. So that was the decision. Is it worth? Do we have the time to buy and stay and do this again in a year?
Yeah, for sure. And how did that military experience shape your approach to investing or how you thought about it?
I think what it did is you understand the value of teamwork and how important that is to multifamily and to larger, commercial real estate. Because certainly as an individual, one can buy a house. You have to make some money, and I'm not saying it's super easy. You got to qualify and all that things, but you can do that as an individual or as a couple. Clearly, that's kind of the American dream, and it has been for a long time. Some people will argue that now, but to me, that's still an American dream, to own your home. And so
Definitely, yeah.
that can be done. But when you start buying large multifamily, you can't do that as an individual. You need experts that can do specific things within that property. You need a property management team. It's not like one individual, it's like a whole team of people, depending on how large is the acquisition. You need an asset management team, because now you're dealing with investors, and investors care not just about the property. They want to know how their money, what kind of return they're going to get on their money. So you need to have an asset management team. You need to have people on the ground, because a lot of times when you invest, you're not investing where you live or near where you live. You're investing where the best returns are for investors.
Yeah.
There's a whole other dynamic that you have to put into play. And for me, that's the military. Military is made up of components. You have infantry, you have artillery, you have intelligence, you have all these things, and they're all part of an operating system. And you need the same kind of system, different names, different things, but you need a system for commercial real estate.
Yeah, for sure. And so when you switched from doing single family homes to multifamily, what did that first year look like? How did you acquire the team, and how did you start going in that bigger venture?
Yeah, I think that the way that I started was as a passive investor. As I mentioned, I initially a few deals as a passive investor only. And what that allowed me to do is I was still actually in the military, and I was able to kind of peek behind the curtain to see how it worked. Because I understood single family. I had a good sense of it. I obviously had education. I had my master's in business. But at the end of the day, you got to see what's going on. And so there's a couple of ways to do that. One is do what I did, invest in a team, in an existing acquisition where you have that network of people that are already part of the deal. Or you can, what some people do is they invest in a mentorship and a mastermind or some sort of educational program that allows them to feel comfortable doing it. In my case, went the passive investment route, and really I talked to the sponsors of that acquisition. I said, I'm really wanting to be an active investor soon. I'm getting ready to retire soon. I want to be an active investor, but I'm going to place my money here with you all. One, I like the location. I did my own analysis of the location. But two, I like your team and what you're saying and the education and that you're willing to educate us that are sort of straddling that, passive versus active role.
Yeah.
That's what I did. So a couple of deals, our initial deals were simply me watching and asking questions and being part of the process. Once I went and I was in the retirement phase and I was literally transitioning, I went ahead and I had some money. I sold one of my single family properties and I took that money so that I can basically have skin in the game and invest in the deal as a general partner in a separate deal. Because it's one thing for you to go up to someone and say, hey, I want to be part of this deal. I'm excited and I want to do this. But at the end of the day, show me the money, right? And so I
Yeah.
wanted to go in and say, yeah, I want to be part of this, but I'm not just trying to, freeload here. I'm willing to do my part, put my money in, and also help, with the rest of what happens after you buy, because the real work starts after you acquire something. That's when you
Yeah.
get into the daily grind, if you will.
For
So
sure.
that's it. I put some money into a deal. I had an opportunity. I networked and I found some people that were willing to work with me and wanted to bring me on as a general partner.
Yeah. And so is that when you started MI Real Estate? And basically, how did you go from starting out there to acquiring over $150 million worth of multifamily assets? What's the investment strategy behind that success?
Yeah. So MI Real Estate really is really the hat where I kind of, I guess, the holding company, if you will, where I did all of my other stuff, whether it was single family, whether it was multifamily, whether it was just partnering with someone to lend money to an institution, right? Because I was also a private lender and I would lend money to fix and flippers and other things. So MI Real Estate was kind of the operational entity, if you will, that allowed me to do all of that in between without really owning a lot. Because when you're in a real estate business, the last thing you want to do is you don't want to have all your real estate eggs in that one basket, right? So
Yeah.
you have to diversify. So essentially, every acquisition has its own company. And so, I talk a lot of times. I say I'm a real estate entrepreneur. I essentially have several series LLCs, and each series LLC has several children underneath it, and each one of those owns an asset. So that if we have any kind of legal issues, that's the exposure that we have, is simply that one child in that one series.
Makes
So
sense.
I started from just an operational company doing things to moving into a series LLC, where now the structure is a little bit more kind of, it's not wheel and spoke, because it's more of a top controlling entity and then children underneath it. But it serves the same purpose to allow you to protect your assets.
Yeah. Got it. Makes sense. And so you focus a lot on value add multifamily properties. Can you explain what that means and why it's a great strategy for investors?
Yeah, and truth be told, I used to do a lot more value add than I do now, but I'm happy to explain it. Value add essentially is very much in the multifamily space, is very much like fix and flip in the single family space. You buy something cheaper, you fix it up, and then you sell it for more. You increase the rents, and then at some point you sell it. Well, that's the kind of the same thing on the multifamily side, except we call it value add. You buy a property, you start improving the exterior of the property, you improve the units as people move in and out, you improve those, you add value to those units, and then you raise the rents. That that additional revenue from the rents and that additional net operating income then in turn translates to higher sales prices when you sell it. So it's the same strategy. So, but typically that works when you're looking at C class assets, maybe B class. C class assets are a little bit older assets, maybe 80s at this point, early 80s is a C class, and certainly anything below that in the 70s at this point is probably not even C class. But anywhere between the 80s is C class. You start getting into the 90s and 2000s, you're into the B class space. And then when you get into newer stuff, then now you're talking about B plus and A class
Yeah.
assets, right? And so, but those don't have a lot of value add. Essentially, what you're doing is you're buying something new. If you buy it at a great price, you can increase the value by simply you bought right, right? That can happen no matter what you do. but a lot of your value add is in that lower quality space where you can actually make some improvements and then immediately raise some rents and add value. So that's what
Yeah,
that stands for.
awesome. So with Stressless Capital Fund, it's one of your newest ventures. And how does that make investing easier for people? How are you kind of guiding them along their journey in investing?
Yeah, there's several ways. So Stressless Capital Fund is a customizable fund. And what that means is it allows investors to invest in one fund and still be able to pick what assets they want to invest within that fund to diversify. It also makes it easier because there's only one set of paperwork that you have to fill out when you first enter the fund versus if you were to try to do the same thing, replicate that and invest in several multifamily assets, every time you invest, you have to fill out a whole brand new set of paperwork. So one, it's a lot less convenient. The other thing is through the fund, we're able to leverage same thing that we're leveraging. You were scaling because we're leveraging a little additional capital to then negotiate better deals with those operators. If I have $100,000, that's a lot of money. But when you're talking about millions of dollars that's going into an acquisition, it's not as much, right? So, but if I can bring in $1 million, about $2 million, and bring that money into a deal, all of a sudden now that gives me negotiation space to increase the value for those investors inside the fund. The other thing that it does is when you invest in, and I'm talking about syndications is the model that we typically work with. Syndications, and we can talk about a little bit that, but that's essentially is a way to structure a deal so that you can bring multiple monies from different people into one deal. So you use the
Okay.
syndication model to kind of grab all that money and combine it.
Yeah.
But through the fund is its own syndication then allows us to invest in multiple deals. Once you invest in the fund and our buy-in in the fund is 50,000, which in a lot of times is much lower than what these typical syndications require. They typically require $100,000 or more. So you can buy in for less, and then once you're in the first deal, then the next time you want to do a deal to diversify, you only need $10,000 versus having to come up with another $100,000 before you can get into the next deal. Because what happens is, no matter how much money you have, at some point you start running out of it, and you got to figure out how you can operate. This gives a little bit more flexibility because you don't have to come up with $50,000 or $100,000 every time you want to diversify and invest in something new. You can do that through the fund, and because we have additional leverage, you can actually get a little bit better deal on the actual investment versus trying to go direct. So those are the main reasons. The other thing is why we've transitioned to the fund and why I like it personally, which is, I guess, a little bit of a different question, but it's just something to go into. It's because I enjoy the ability to travel, the ability to do things, and so long as I have internet, so long as I have essentially people that are doing things in the property itself, the team, then I can move around, and that's something that I enjoy. I like to travel, and I
Yeah.
like to meet with people. If I'm stuck, sitting there watching a property where I have to be near the property, it hamstrings my ability of doing what I like and what I enjoy after I retired. I mean, I've been sitting at a desk for so long in a lot of these jobs in the military, especially as a major and colonel, and a lot of times you're just sitting there doing desk work, doing slides and sitting instead of actually doing something physical. So I
Yeah.
retired and I don't want to do more of the same. I needed to learn all the stuff, but at this point, I'm really looking forward to doing the things that I enjoy, and that means I have to bring capital to these deals, and I bring my own capital as well.
Yeah, that's very awesome. I think that's very nice that you are able to just kind of, sit on and travel on a vacation, and it's all working for you. That's kind of the goal in life, right? To be able
Yeah,
to
have
make
have
that
some
passive
space.
income. Yeah,
Yeah,
for
and I
sure.
think a lot of people after the pandemic, a lot of folks saw that, hey, this is not bad. I can work from home and I can live where I want, and I know that some of that's gone away, but
Yeah,
that's kind of the feel of it, right? I'm
yeah,
not tied to a place on the ground. I can move around, and I
yeah.
love it.
Yeah, that sounds amazing. So kind of moving now into some industry trends in the market. Multifamily investing has been booming, but interest rates are very high right now, and inflation. So what has made that, or what kind of challenges has that created for you, and how are you navigating that?
I think the biggest challenges that it had, particularly in the value add space, and this is why I've kind of weaned off of the value add, is essentially when you do a value add deal, you enter into a much shorter not interest, a loan product. So instead of, 10-year product, typically you don't see 30-year mortgages in commercial. You normally see 5 to 10 years is kind of your typical. Well, when you're doing a value add, because the idea is to fix it up and then take some of that value out and give it to investors, you tying yourself into a floating rate in some cases, or some sort of a shorter time frame. And so you expect that the rates are going to go down, or at least what you projected are going to be, reasonable to what's actually happening. And we know after the pandemic, the Fed, initially said there's no inflation, there's nothing to see here, there's nothing to see, and then all of a sudden it's like, wait a minute, there's all kinds of inflation. And then in about a 6-month period to 9 months, they bumped the Fed funds rate significantly. And what that does is it drives the interest rate. So you had a lot of people that were in deals, value add deals, that thought they were going to have nice cash flow in properties that all of a sudden they couldn't refinance out of. And they need capital to basically essentially keep that property going until we got out of this rut. And so that was very, very hurtful to the industry. And we had a couple of those deals where we expected to be able to provide more cash flow to investors, and there was just no cash flow because you had the higher interest rates.
Yeah.
And so that was that's why we sort of we made our transition into more of the Class A and the B plus and Class A space, because there's a lot less risk in that space. You're not doing a lot of value add. Essentially, you buy right. So that's what's been the riskiest, but it's also what's presenting the most opportunities, because you have a lot of distressed properties out there with owners that are trying to do something. They can't refinance it because they're not going to get what they expected to get, so they have to sell. And what that means is they're having to sell at lower price points, which is an opportunity for those people that can go in and grab those deals.
Yeah. That's awesome. Yeah. So basically, moving on to some other trends. What are some new trends in the market today that are exciting you and that you think will be a big part of the future?
Yeah, I think the biggest thing that we're seeing right now is that we have for a lot of years, especially after the pandemic, it was very difficult to build single family. The costs were high. There was no supply for materials. It was just hard to do single family. So all the builders that were doing development said, you know what, let's focus on multifamily because that's the moneymaker. We don't have to worry about it. We're going to develop new multifamily. Well, there was so much of that you had an abundance of multifamily. And now all these deliveries were coming onto the market, and it's too much supply. So it was actually the opposite of where we were before, where there was not enough supply. We just basically saturated, especially certain markets that were doing really well. So now all of a sudden you had a scenario where you had essentially tenants that had a choice where they wanted to live, and there was a lot of choices. And so you had to drop rents to some extent. It wasn't crazy, but it was enough where it was depressing the market. And so now all these deliveries have just about gone full cycle, because for the last couple of years, it's been too expensive to do development deals. Too much, construction loans are too costly, and the developers were like, we're not going to do that. So you went from, now you have all this absorption that you had to burn through, and all of a sudden now we're going to be back on the other side where it's more demand and less supply. And you just follow that trend. Right now, at the end of this year and starting next year, we're going to see, because the good places to live are still good places to live and people still move there. But now all of a sudden, there's going to be less places for them to rent.
Yeah.
So that's going to help us drive and stabilize those rents that for the longest time have kind of gone the other way.
Definitely. And with the building side of it, do you see yourself ever getting to building some multifamily properties, or are you just going to stick to investing it?
Yeah, that's a good question. I like to work with developers. In fact, we're looking at some development stuff now, but I don't want to be in that space. I mean, I essentially want great operators that can develop the property and then lease up the property, and then we bring in our investors when all of that is done. There's a little bit less upside because a lot of the risk is initially in that development side and the lease up side. But I'm much more, and the investors I'm dealing with are much more comfortable with a little bit lower returns. And we're still talking great returns, but just a little bit lower. But by doing that, you're not exposed to as much of the risk. So short answer, no, I'm not really looking at development, but I am working with developers.
Yeah, for sure, definitely. And with the new boom of AI, do you see that affecting the real estate market with like sending messages to tenants, having rents be estimated by AI or anything like that? Do you see that being something that's gonna become a big part of real estate?
I think so. I think we're going to see more of that. And essentially, the opportunities in real estate present themselves because it's an imperfect market. The information is not perfect. It's not like you can get on a computer and ask a question and you're going to get real-time data about rents. So that's always been why some people are just able to get better deals because they pay for the information, and then some of this information can be costly.
Hmm.
They just have that they're connected and networked with the right people at the ground on the ground that is able to give them that information. Well, the more AI becomes a factor, the more it's easy for people to have access to the same information. So it levels the playing field to some extent. It's not going to be group perfect, but it is getting better. So on
Yeah.
the side of just understanding pricing and rents, there's already stuff out there. It's still a little bit costly,
Hmm.
but those prices are going to go down as it becomes much easier to get access to that data.
Yeah.
On the rent side, for example, if you're looking to improve your property management, you don't have to have as many people on the ground. I mean, and this started really right after the pandemic in many cases where you have systems in place where if you want to go see a property, you can do all of that online. You can register, you can give your information, you can essentially do your application, and then you go to the property and you type in a temporary code that gives you access to the actual place where you're looking to rent. And you can walk it, there's cameras, and you don't need the person there,
Yeah.
the property manager, the leasing agent there. So some of that's already happening. It's facilitating, and it's all based on technology and sometimes AI kind of putting these things together. Yeah, the downside is a lot of times you're going to have some disturbance in the job markets, and that's just not with just rents. That's just not with multifamily and real estate. That's anywhere where AI can do something for cheaper. It's bound to happen.
Yeah, definitely. Yeah, I agree. It's pretty crazy how the jobs will be looking in the future. The AI will be able to do it, like you said, cheaper and way faster as well. So that's something that is crazy. So you were talking about the systems that are being implemented. Have you guys looked into those at all, or do you see yourself using those in the future?
We've started using some systems. I think most people that are in the space are using it for marketing purposes, are using it to help better analyze underwriting of the property. What are the financials? It used to be that you have to kind of go through that stuff with a fine tooth comb. Now you can import an entire spreadsheet, entire financial report into chat GPT or some other form of AI, and it'll give you some of the answers that would have taken hours to do. Now you can do it very quickly. Contracts, you can get a contract into a computer. I'm not saying you trust a computer before you sign on a dotted line on these contracts, but if you're doing some basic evaluation of a purchase agreement or a property management agreement, you can run that through several systems nowadays that can give you and highlight some of the potential issues and concerns that one would have by paying an attorney, for $500 for an hour's worth of work. You can get a lot of that up front now with just AI.
Yeah, yeah, that's pretty crazy stuff. I think it's going to be interesting to see where that takes the industry, definitely. And so now I want to move in some challenges and some things that are going well with your company right now. So what is some of the biggest challenges you are facing today, and how do you look to solve those challenges?
Yeah, I think the biggest challenge is whenever you hit a little bit of a downturn in the economy or in real estate, what typically happens is you have this trail of negativity. And so, right, and honestly, this is when it's the best time to buy and to put capital in place because you got better pricing. We're getting better deals. I mean, we got a deal right now in Bentonville, Arkansas, where the Walmart headquarters, where essentially when we buy it, We already have $6 million in equity. We're buying it for less than it takes to build.
Yeah,
And it's a fantastic opportunity. But not everybody's comfortable. So they're holding onto their money when they should be investing their money. It's almost like it's reverse psychology. And so you have the Warren Buffetts of the world that are going out there and this is where they're putting their money out play. A lot of people are holding on to that money thinking that this is the best strategy. And all they're doing is they're missing opportunities. 2 years down the road, they'll be like, God, I wish I would have done this. I wish I would have done that. So the hard part for us and what I try to do is I try to, explain this to people and educate people and say, you're gonna miss out because this is when you buy low, you don't buy high. And we're right now in there's some great opportunities out there for the things we've already talked about. So it's
yeah,
just mindset, changing the mindset of some investors and getting them to invest that because they have the money and it's sitting there, but it's sitting in low interest bearing accounts instead of putting it in play into larger deals where you're making 20% annual returns over a 5 to 7 year time span, right? And so it's just, I think that's the hardest thing from a capital perspective. And so if you're talking about acquisition, the other part that is hard is you're trying to buy things and the pricing is right, but do you have the lenders that are willing to lend the money? And that has dried up as well. So your capital markets on both sides have dried up a little bit, and it makes it harder to do deals in the short run. So those that have the money right now and can get the money, they're the ones that are going to control things a few years from now. They're going to be sitting very happy. And those that are, basically been hoarding their money thinking that the opportunity is tomorrow, they're just going to miss out.
yeah. It's almost like a scared money don't make no money, you know?
Yeah, it's a
Yeah,
it's a scarcity mindset,
yeah,
unfortunately, and many people have it for a lot of reasons. I mean, you may be close to retirement, or you have kids, and you just can't you can't be completely risk averse either. You have to be kind of somewhere in the middle, and depending, each person's different, how much they're willing and can take risks.
for sure, totally. And now, kind of moving into your future goals for the company in the next 12 to 24 months, are you going to continue to look at buying more of those properties at the low price, or what's your goals for the next year or two?
Yeah, I think our goal is to continue to add additional capital into our funds so that we can maximize that and really just identify the right kind of operators. And frankly, that's difficult as well. It's very easy to be successful in real estate if you buy when the tide is high.
Mm-hmm.
It's you can do no wrong. I mean, you're gonna do okay. But when things get tough, you have to tighten up operationally. You have to be willing to work hard and spend the time. And I think you get a lot of folks that have been in this space for a short amount of time, but they just got in at the right time, are now getting out. And so what we have to do is we have to vet very carefully those operators that we want to do deals with because we don't control the operations. So we have to vet those operators carefully, not just the deal, but even before the deal, we want to make sure that those folks have been consistent in the market, they have the experience, and they've actually been able to deliver in the hard times because everybody delivers in the easy times. But when it's hard, did they stick with it? Did they make the right kind of decisions? Did they communicate what they were doing to their investors? A lot of times when things go bad, some of these operators, they feel like, okay, they're just going to put their head in the sand and hope the problems go away. They don't go away. All you're doing is you're making them worse because you're not letting investors know and communicating with investors what you're doing to try to fix the problems that you're having. So it actually is actually very prevalent, unfortunately, and a lot of people do that. So you got to communicate more when things are hard. So we're doing a lot of work to vet operators to make sure that when we invest in deals and we bring investor capital into those deals, that it's with the best operators possible that are really going to overperform.
Yeah, for sure. And how are you looking to find those operators? Is it with Stressless Capital, or how are you reaching out to them and finding them?
Yeah, through Stretchless Capital. So we built basically a three-phase vetting process where initially, we have some initial discussions with investors to make sure that philosophically we're in the same space. We do our own basic research. We talk to people. It's not a huge community. There a lot of folks know each other in this space, so it's not hard to go and find investors that have invested with certain operators. So you kind of do your own research initially, and we would do that before. But what we're doing now, that's a lot more. That's probably the strongest part that we're doing is we're taking that information and then we're asking them to let us run their background through very, very stringent background systems. We use Clear right now, which is the one that's in the airport.
Yeah,
So
yeah.
we run their backgrounds through the Clear system,
Wow.
not just for their person, but for their entities that they've been involved with. So then we've talked to them, we ask them to provide us some information up front, and then we verify that what they said is actually what's in the system. If there's some anomalies, then we right away we zero in. Okay, well, it says you had a bankruptcy 10 years ago. We asked you if you had any bankruptcies, and you told us no. Well, that's an immediate, you got a problem. You're just not even reading the information,
Yeah.
or you're withholding information. So that makes it very simple to go to identify a lot of the bad apples.
Yeah, for sure.
I'd rather to work with someone that says, yeah, I had a personal bankruptcy 10 years ago because in 2008, whatever, whatever, and give it an explanation of what happened and be upfront about it. I mean, if it doesn't work, it doesn't work, but at least you were transparent. I'd much rather have that than somebody that tries to hide information, because that's an automatic foul. That's a flag.
Yeah.
So that's step 2. And then step 3 is then we take all that information and we go back to investors. Now that we've spoken to them several times, we go back and reach out to investors and other managers and partners that they've worked with and say, hey, have you talked to, we're working with this guy. What do you think? A lot of times they won't tell you, oh, yeah, that's a guy. You don't want to work with them, right? Because for legal reasons, they may not tell you. But you'll get the feeling real quick, like, I don't have any comment. Well, that is a comment.
Yeah.
Not having a comment is a comment. So we go through that 3-phase process. And after we do that, then we start looking at properties with them if they pass. So that's just them. That has nothing to do whether they have good deals or bad deals. It's just, are they good operators?
Yeah, love it. Yeah, I mean, going back to what you said on step 2, you don't want to work with anybody. If they're hiding some stuff and they're not being honest, then they're probably going to have bad business and not be honest when you're doing business with them. So, yeah, I agree. And so now I have my one last question that I do on every single podcast. What book has been most impactful for you on your journey that you would recommend others to read?
I think there was a couple of books there. The Cash Flow Quadrant is one that sticks to mind, Robert Kiyosaki, because it talks about, it's foundational. A lot of people, it's kind of, I don't want to say it's like the Bible. It's not like the Bible, but it's philosophical. It's about taking the certain approaches in life. It's not going to explain the things to the detail that you need to know it, but it gives you enough of a vision of a concept that you can then employ. And that's just a book that, for me, it really helped me to kind of focus on what was important, right? Okay, if I do these things, it's gonna set me up for success. Now, there's a lot of learning that needs to happen. You need to have people that can kind of be your left and right limits to make sure you don't do anything crazy. But it's kind of going in the right pattern. Now, the other one that really comes to mind is, and again, Robert Kiyosaki is, it's what is that? The book about his father, right?
Rich Dad, Poor Dad?
Real Dad, Poor Dad. Exactly. Yeah. So that book is also very philosophical in nature, and it helps you sort of think about things a little bit differently, good and bad approaches.
Yeah.
People argue, like, did he really have, is this really factual? I don't know. But the concepts are good concepts. And so that's what I approach it from that perspective.
Great. Awesome. Yeah. Well, thank you again for hopping on the call with me. I appreciate you for taking the time out of your day. Thank you for all the information and the insights. It's very helpful, and I appreciate it a lot.
My pleasure. And by the way, it's Rich Dad, Poor Dad. I don't want Robert Kiyosaki to give me a call.
Yeah, definitely. Yeah. That's awesome.
I appreciate it, Roman. And thank you for what you're doing, and good luck to you, and anything I can do to help you.